Hello? Hello? Sir, unmute. Unmute, sir. Unmute.
Now you can hear me?
Sir. So, good afternoon, sir. I welcome you in this fourth session today in the fifth faculty induction program organized by HRDC Mizoram University. And dear participants, now we are having today for this fourth session Professor Ajay Kumar Singhal ji. He is a senior faculty member in the Department of Commerce and Business Administration in Allahabad University, which is one of the oldest university in India. And he's taking a very, very relevant, very, very interesting topic, which is actually concerned with all of us. That is tax planning for individuals. So, as individuals, whatever salary we are all having is we are supposed to pay tax on that. We are expected to calculate it. We are expected to file our return, and we have to pay all those tax ourselves. So it's not like that we leave everything on our college or university administration to deduct TDS and deposit. It's not like that. That is the part they are doing. We need to verify it, whether proper deduction is there or not, and whether it is being deposited or not, and then finally filing of the tax. All those things, it is our responsibility, which many of us are actually ignorant about that. So we requested Professor Singhal sir to speak on tax planning and focusing only on individuals among you and me and himself. So he will be taking up this topic and he will be enlightening us on how to plan our tax. And this will go beyond Section 80C, what we only think that only some investments, some GPF or NPS and tax, insurance will do. He will go beyond that. So please put your questions in chat box so that he can respond to that also along with this discussion or towards the end of this discussion. So, sir, Professor Singhal, sir, now time is yours. You may start discussing the topic. And, sir, this is an induction program, so different persons from different streams are joining here, and all are new faculty members, and they are not having access to audio, so they will be putting their questions in chat box, and during the discussion or towards the end of the discussion, we will take up the questions. So now time is yours, sir. You can start.
Thank you, Professor Singh. And I'm happy to address the teachers, my colleagues.
Sir, sorry to disturb. Sir, your lighting, I think back side one tube light is there, so your picture is not very clear. Earlier it was fine. Yeah, now it is fine, sir.
Now it's fine?
Yeah, it's fine now, sir.
All right. So may I know how many participants are present right at the moment?
26, sir.
26.
26.
28 and as you
are
said
there,
they are from various streams.
Okay. Yes, sir. Yes,
so
sir.
Many of them who are from the science stream or art stream have very little knowledge about income tax. Those who are from commerce stream, they might have little knowledge, basic knowledge.
Yes.
But today my aim is to give you tips regarding tax planning. Now, one thing is, we hate to pay income tax, but government loves to take. And especially we salaried class people, we cannot evade any taxes. There is a provision for tax deduction at source, TDS. So when we get our salary, tax is already deducted by the employer and the balance amount to paid to us. So there is no scope for tax evasion, what you call it as tax ki chori, no scope for that, for salaried class people. Salaried class people, they have, besides salary, they have income from many other sources. First, I'll tell you basic thing that first you have calculate your gross total income. Total income that you earn is divided into 5 heads. And we add that up, we get gross total income. So 5 heads you already know: salary head, house property, business profession, income from capital gain, income from other sources. So these are the 5 heads of income. So we calculate our income from all these 5 heads separately, and then we add it up, we get gross total income. And out of that, we get deductions under section 80. And after getting deductions under section 80, then you get the total income, that is the final income on which you are supposed to pay the taxes. Now, our finance minister has introduced two rates of taxes: one with exemptions and deductions, another without exemptions and deductions. And perhaps you already know those rate of taxes. Since you all are teachers, you are already paying income tax. So you must be knowing those two rates of taxes. First, 2,50,000 is exempted, then 250 to 5 lakh rupees, 5% tax, then 5 lakh rupees to 10 lakh, 20% tax, above 10 lakh rupees, 30% tax, and then there is a 4% surcharge cess, education and health cess. This is the old regime, and the new regime, you know, up to 2,50,000 it is exempted, then 5%. Every 2,50,000 they have increased the rate by 5%. So 250 exempted, from 250 to 5 lakh rupees it is 5%, from 5 lakh to 7 lakh 50,000 it is 10%, then another 2,50,000 it is 15%, another 2,50,000 it is 20%, and then in this case, under the new regime, your 30% slab starts after 15 lakh rupees. Now, SSEs have been given the option to choose either the new regime or the old regime. If you have started your career and if you are earning up till 7 lakhs per annum, 8 lakh per annum, then in that case, I have made a comparison. The new scheme of taxation is better for those who are earning up to 7 to 8 lakh rupees. Because this new scheme where 2,50,000 is exempted, then 5% tax, then 10% tax, then 15% tax on every 2,50,000 is good for only those people who are earning up to 7 to 8 lakhs. If you are earning more than that, then it is advisable that you opt for the old scheme where you get exemptions, where you get deductions. So may I get a feedback? How many of you have opted the new scheme and how many of you have opted the old scheme? How many of you have opted the new scheme and how many of you have opted the old scheme of tax payment?
Sir, they're not having access to audio, but they're writing in chat box. So far, 3, 4 have written old, 2, 3 have written, 3, 4 have written new. So some,
Oh,
okay.
so I have told them that if you are earning up to 7, 8 lakh rupees, then the new tax regime is okay. If you are earning more than 8 lakh rupees, then it is advisable that you go for the old regime. And Professor Singh, I'm sure you have opted the old regime.
So far, yes, old sir. Every time I compare both, I calculate both, and
No,
some 3,000 rupees difference is there in old.
yes, so it is better that you opt the old.
Yes, yes.
So there you get deductions and exemptions, and the new tax structure, there is no exemption, there is no deduction. There are 70 exemptions and deductions which have been withdrawn as far as the new tax regime is concerned. They have reduced the rate of taxes, but they have removed the deductions and exemptions. All right. Now, as I said, nobody wants to pay income tax. There are two things. One is tax planning, that is our right. Another thing is tax evasion, which is a crime. So as good citizens of the country, we must always try for tax planning. What is tax planning? If within the legal framework, you know, there is an Income Tax Act. Within the legal framework, within the scope of the Income Tax Act, if you are able to minimize your total income or you are able to minimize your tax liability, that is called tax planning. That is our right. Many of you must have engaged chartered accountants to file your return, to give you tips about income tax. What do the chartered accountant do? They give you the tips how you can reduce your total income, how you can reduce your tax liability. So today my lecture will be more on those items, those tips that will help you to reduce your tax liability on the one hand, and on the other hand, to maximize your returns also. Now, as you know, you are a salaried class person and you must be having some amount which you save. And in Indian culture, Indian traditions, has become our habit to save something or the other out of the income that we earn. And the youngsters who are just starting their careers, now they have a little slightly different concept. They are of the view, eat, drink, and be merry. They believe very little in saving. They believe more in spending. But if I ask you that by saving money, you can save taxes, then every one of you will gladly agree to it. Yes, sir, we can save taxes. We are very happy about it. Tell us, we are ready to save. As Professor Singh has pointed out in the beginning, one deduction section 80C. Now that is almost claimed by all of you. Up to 1,50,000 rupees. If you save, and not only save, if you invest your money in specified items, then you get deduction under section 80C up to maximum 1,50,000. But there are many schemes, many items under section 80C. There are many options under section 80C. To be precise, there are 25 options, 25 schemes from which you have to select where to invest up to 1,50,000. You can invest in one, or you can invest in 4, 5, 6, 7. Maximum deduction you can claim is actual amount or 1,50,000, whichever is less. So among section 80C, one is LIC policy. Many of you must have taken LIC policy. The premium that you pay, that qualifies for deduction under section 80C. Then Provident Fund. Provident Fund. That also, your own contribution towards Provident Fund, that also qualifies for deduction under section 80C. Tuition fees of 2 children. Now people who have children, middle class families, they are hardly able to save because of the education of the children. So there is a provision in the section 80C for 2 children, school fees that you pay is treated as an investment and you can claim deduction under section 80C. There is one scheme, Public Provident Fund, where you can open your account in a bank. This scheme is for 15 years. This is a very good scheme as far as taxation point of view is concerned. I'll give you a brief about PPF. You open an account in any bank, minimum 500 rupees and maximum 1,50,000 you can deposit in this bank account. The account will be opened by the name of PPF account. Whatever you deposit every year qualifies for deduction under section 80C. Suppose you put 80,000 rupees in your PPF account, put 80,000 rupees, you can claim a deduction under section 80C. Then the amount that you deposit, the scheme PPF is for 15 years. So every year you go on depositing amount. After 15 years, you will get your money back. You will get your refund. And interest every year, it will be credited in your account. At present, the rate of interest is 7.1%. It changes once a year, twice a year. Government changes its rate of interest. At present, it is 7.1%. Now, 7.1%, the interest that you get is fully exempted from tax. There is no tax on PPF interest. And the refund that you will get after 15 years, that is also fully exempted from tax. So this is a lovely scheme. The amount that you deposit, you get deduction under Section 80C. The interest, 7.1%, fully exempted from tax. The refund after 15 years, fully exempted from tax. So one of the best schemes. And it is a secured scheme that guarantees by the government of India. So it is a secured investment. And through this scheme, you can have financial security. After 15 years, you get your money back. And even after 15 years, you don't require money. The scheme can be extended for 5 years, as many number of times you want. You can go on extending it for 5 years. Long-term investment, it's a very good scheme. Now, since many of you must have invested in LIC, let me tell you, LIC, suppose you take for 25 years policy, and every year you pay premium of 50,000. And PPF also simultaneously, you open an account PPF and deposit 50,000 every year for 25 years. The return in PPF will be much, much higher as compared to LIC. LIC gives you a return of hardly 5% or 5.25%. Although whatever amount you receive from LIC, that is also fully exempted from tax. But the rate of return you get in LIC is much, much lower as compared to public provident fund or as compared to any other scheme. Because LIC is also taking the risk. It is insuring your life. Suppose a person takes a LIC policy for 25 years and he dies after 10 years. So he has paid premium only for 10 years, but the LIC will have to pay the entire insured amount to his family. So LIC is taking that risk. So as against that risk, it charges you some cost. That is the rate of return the LIC gives you. That is, if a person doesn't die, when he gets his money back after the expiry of the policy, the rate of return is much lower as compared to any other scheme. Rate of return is hardly 5% to 5.25%. So PPF that way scores higher over LIC. The only thing is LIC covers your life, but PPF doesn't cover your life. And if you are in the age group of 30 to 40 and you take a 20-year LIC policy, there are more chances that mortality rate in India is around 60, 65 years of age. So more chances that a person will not succumb before the age of 60. And if a person doesn't succumb, and when he gets his money back, he repents that had I invested this money elsewhere, my rate of return would have been much higher. Friends, not only is that you earn money, more important is how judiciously you invest your money. And your aim should be to maximize your return, to earn as much return as possible on your hard-earned money. Another item of investment under Section 80C is Equity Linked Savings Scheme, ELSS. ELSS. Now, a lot of people put their money in Equity Linked Savings Scheme. This is concerned with the stock market. So stock market is always a risk. The returns can be very high also, it can be high, and it can be low also, or it can be negative also. So there's a risk component as far as this scheme is concerned, equity linked saving scheme. But over the last 5-10 years, when I made a research, I found that most of the ELSS schemes, give a return of between 15 to 20%. Minimum return is 15 to 20%. So which is much, much higher as compared to LIC, as compared to even PPF, or as compared to any other investment that you make. 15-20% return is quite good. So a lot of people who have risk appetite, they prefer to invest their money in equity linked savings scheme. Now, equity linked savings scheme, whatever money you invest, you get deduction under section 80C. So these are some of the items, investments. Another is new pension scheme. Now, majority of you are covered by new pension scheme. So new pension scheme, whatever you contribute towards the new pension scheme, that also qualifies for deduction under section 80C. Now, there is one more section, section 80CCD, where whatever you contribute towards your NPS qualifies for 80C, plus there is a provision for additional 50,000 rupees. If you deposit in your NPS from your own savings, then you get additional deduction of 50,000. That means 1,50,000 under section 80C and another 50,000 under section 80CCD. So if you can save your money for retirement, NPS is for your retirement benefit. At the time of retirement, when you contribute more during your lifetime, your returns will be, your money will be much, much higher when a person retires. So that depends what you decide, what is your family need. So that you have to decide. According to your need and circumstances, you can make your investment. Now, besides 80C, there are other things also which are very important. Many of you may not have been knowing one scheme, that is Sukanya Smriti account. Now, this is for those people who have daughters. A daughter is born, you can open an account in her name in Sukanya Samriddhi account scheme, and there whatever amount you deposit in the name of your daughter, that will fully qualify for deduction under section 80C. And this amount, when received by your daughter at a time when she is 18 years of age or when she is 21 years of age, this amount is also fully exempted. The interest that you earn is also fully exempted. So all those of you who have minor daughters, I would advise you to open this scheme, Sukanya Smriti account scheme, where you can open an account in the name of the minor daughter and you get benefit under the Income Tax Act. Interest part exempted, refund part will also be fully exempted. Besides that, now illness. Now illness, we have seen the pandemic, Corona is behind us. We have seen how many of us, our families were badly affected by the epidemic. Almost in every family, some or the other person, he or she was affected. Now there is one deduction, what we call it under section 80D. 80D, that is related to health insurance premium. Health insurance. Section 80D. Now, health insurance, if you are covered by CGHS, then it is fine. But if you are not covered by CGHS, then these days health insurance is advisable and the deduction you get is up to 25,000 rupees per annum. Yani whatever premium you pay for your health insurance, actual amount of 25,000 is allowed as a deduction. And if you take a health insurance for a senior citizen, then the deduction is up to 50,000 rupees. So in the name of your parents also, if you take a health insurance policy under Section 80D, you can claim deduction up to 50,000. For yourself, you can take deduction up to 25,000. Interesting part. Now, this point many of you may not be knowing. Many of you may not have taken health insurance. Many of you may not have availed the deduction under Section 80D. Suppose you have not taken health insurance, you have not taken medical insurance. Still, 5,000 rupees deduction you can claim under Section 80D for medical checkup. Now, friends, these days our lifestyles have become so sedentary, so faulty, that once in a year we must have a full body checkup. The saying is prevention is better than cure. So before any disease crops up, becomes severe, you can kill the disease in its bud if you know beforehand what is growing up in your body, what bad is going on in your body. So that is when you take up a full body checkup once in a year, and for that up to 5,000 rupees, you can claim deduction under Section 80D. And I'm sure many of you may not be opting this deduction. So up to 5,000 preventive medical health checkup deduction you can claim under Section 80D. Now, there are many other deductions. Many of you are authors who might have written book, and people who write book, they get royalty income. There are some deductions which are available on royalties, and royalty income, the deduction is Section 80QQB. Section 80QQB, deduction in respect of royalty income of authors. So if you have written a book on which you get royalty income up to 3 lakh rupees, one actual amount, maximum up to 3 lakh rupees, you can claim deduction under Section 80QQB. So this is also very important deduction, especially for those people who are authors, who have written books for graduate, postgraduate level, reference books. They can claim deduction under Section 80QQB. One very important deduction is TTA, Section 80TTA. All of you have their bank accounts. Now, when you put your money in a bank, you get interest on that. In your savings bank account or fixed deposit, you get interest on that. And interest amount is fully taxable under the head income from other sources. Fully taxable. But there is one deduction, Section 80TTA, which says that up to 10,000 rupees interest from bank, post office shall be fully allowed as a deduction under Section 80TTA. Many of you might be taking this deduction, and many of you may not be taking because of lack of knowledge. So you can note it down, TTA, up to 10,000 rupees of interest income, you can claim deduction under this section. Now, friends, I want you to generate wealth. And the best way to generate wealth, to create wealth, is the stock market. In stock market, you invest through two ways, either through mutual funds or through direct investing in the stock market. You open a demat account, see the stock market, buy shares, invest money in buying shares, and when you earn profit, you sell shares. And since all these days it is all digital, it is all hassle-free transactions, and it is all online. You can buy the shares online, you can sell the shares online, the money can be transferred online from your account, from the other account to your account. So now it is a hassle-free. Transactions take place in the stock market. And SEBI has become so strict, there is hardly any chance of any fraudulent practices in the stock market. Hardly. Those were the days of Harshad Mehta, Ketan Parekh. Now such scams cannot happen easily in the stock market. SEBI has become very, very strict. Security Exchange Board of India. So if you have knowledge about stock market, you can invest directly. And if you do not have knowledge about the stock market, then you can invest through mutual funds. Now, mutual funds, there are debt mutual funds, there are equity mutual funds. I will never advise you to invest in debt mutual fund. Always invest in equity mutual fund. I hope you understand what is mutual fund. Suppose I do not have the knowledge, but I want my money to be invested in the stock market, and I do not have the direct knowledge. So I can invest in the stock market through mutual fund. I buy the units of the mutual fund. I purchase units of the mutual fund. Mutual fund has got portfolio managers, experts. They invest our money in the stock market, and whatever they earn in the stock market, that is passed on to the investor, the holder of the units of mutual fund, in the form of dividend and in the form of capital appreciation. And mutual funds have given consistent returns over a period of time. There are very few mutual funds which have failed. Majority of the mutual funds have given consistent return of 10, 15, 20, 25% for the last 5, 10 years. In some cases, they have given even return of 40, 50%. That all depends upon the stock market. That all depends upon the portfolio manager who is looking after the mutual fund. So if you want to create wealth, you can invest your money in mutual funds. Or you can invest directly in the stock market. Now, from income tax point of view, let me explain you from income tax point of view. From income tax point of view, if you invest in mutual fund or you invest directly in the stock market, you buy shares, sell shares, there are two types of gains. One is short-term capital gain, another is long-term capital gain. Any income that you earn from sale of shares or mutual funds, that is taxable under your head income from capital gain. In the beginning, I told you that there are 5 heads of income. So among the 5 heads of income, the 4th head, income from capital gain. So whatever you earn from stock market and mutual fund, that is taxable under the head capital gain. And capital gain in case of shares in mutual fund, it is short term or long term. If you sell the units of mutual fund or if you sell the shares before 12 months, then the gain shall be treated as short-term capital gain. I repeat, if you sell your units of mutual fund or if you sell shares before 12 months of investing, within 12 months, then that is treated as short-term capital gain, or if there is a loss, it will be treated as short-term capital loss. And if you hold your units of mutual fund and shares for more than 12 months and you sell it after 12 months, then that is called long-term capital gain. Long-term capital gain after 12 months. So like suppose today, I invest in the stock market, I buy shares of Reliance Industries. And after 1 year from now, if I sell it, it will be called as long-term capital gain. And if before 12 months if I sell, that will be called short-term capital gain. That depends. When I am getting profit, I'll prefer to sell. Now, from taxation point of view, there is a privilege in long-term capital gain. There is a disadvantage in short-term capital gain. First thing, let me tell you, when I said you can multiply your money, you can create wealth through stock market. And in the beginning, I said nobody wants to pay income tax. We hate to pay income tax. Government loves to take income tax. And the slabs I had told you that if you earn above 10 lakh rupees, the rate of tax is 30% plus 4% cess that you have to pay. In case of short-term capital gain on shares or mutual funds, there is a special rate of tax that is 15%. Any amount of income may take place, you have to pay tax only at the rate of 15%. Suppose you earn 50 lakh rupees from shares. You bought the shares and sold it within 12 months and you earned 50 lakhs. So on this 50 lakh rupees, you will pay tax at a special rate that is 15% only. No slab rate, no 30% slab will apply. On your other income, there will be slab rate of 30% if it crosses 10 lakh rupees, but not on short-term capital gain on shares and units of mutual fund. Special rate only 15%. And if it is a long-term capital gain, which means if you sell your shares after 1 year, or if you sell mutual fund units after 1 year, then it will be long-term. And long-term, what is the advantage? Number one, up to 1 lakh rupees of income, it shall be fully exempted. If you earn up to 1 lakh rupee in a year, in your financial year, long-term capital gain, there is no tax on it. It is fully exempted. And above 1 lakh rupees if you earn from shares and units of mutual fund, then there is a special rate of tax that is only 10%. 10% only. So from taxation point of view, it is wiser to put your savings, to put your money in the stock market, either directly or through the mutual funds. If you have knowledge about the stock market, you can invest directly, earn more profits. But if you do not have much knowledge, but still you want to invest in stock market, then the option is mutual fund. The mutual fund is the option. I hope it is clear. Any questions up till now?
So far, no questions came. One question is there in chat box. No, sir, no questions so far.
No
But
questions?
things are very clear, sir.
Things are clear?
Yeah, yes, sir.
All right. So that was creation of wealth through stock market. Now, one more tip that I want to give you. Many of you are youngsters, young teachers. Since you are doing the orientation course, naturally, you must be newly appointed teachers. Many of you might have got married also. Now, two things here I would dwell upon. One is the gift part, other is the house part. First, I'll come on to the house part. Every one of you wants to have his or her own house. As soon as a person gets married, the first thing that the couple wants is to own a house. Owning a house is not an easy affair. The property rates have scaled up, they are escalated. So you have to borrow money if you want to buy a house. And there are a lot of financial institutions which are giving loan readily, easily to buy a house or to construct a house. And loan to salaried class is always preferred by banks and financial institutions because they know the salaried class person will not run away. And they have their fixed amount of income, and the income year by year it will increase. So whatever amount of loan taken by salaried class person, that is called as a retail loan, that is always preferred by banks and financial institutions. So no problem when you take loan to buy or construct a house. Some part you contribute, whatever you have saved over a period of time, 4, 5, 6 years. Then you can borrow money from the banks, own a house, and enjoy income tax benefits. Now, house that you have owned may be used for two purposes. First, you might let it out to a tenant and get monthly rent. This is one option. Second option is self-occupied. You purchase a house, you buy a house, and you live in it, self-occupied. In both cases, you have different benefits under the Income Tax Act. The first thing that I want to tell you, that whatever loan you have taken from bank, the principal, you have to make payment through EMI, equated monthly installments, EMI. Every month you have to give an EMI to the bank. So EMI consists two things. One is the principal amount that you repay, other is the interest component. When you give a EMI, you pay EMI to the bank. Suppose it is 50,000 rupees per month. Out of 50,000, some part will be principal amount that you are repaying, the loan that you are taking, and some part is the interest part that you are paying. The principal amount that you are repaying to the bank or to the financial institution that you have taken loan for the purpose of buying or constructing the house, the principal amount is fully allowed as a deduction under Section 80C. So I told you that under 80C, you have many options, 25 options, and among those various options, option is principal amount that you repay in buying a house when you take a loan from the bank or any financial institution. So 1,50,000 deduction under 80C can be taken. One of the items can be principal amount repaid towards loan that you have taken to buy or construct the house. You can claim deduction under Section 80C. And interest part that you are paying, you can claim deduction under the head income from house property. Income from house property. In the beginning, I told you there are 5 heads of income. One is income from salary, other is income from house property, third is income from business, fourth is income from capital gain, fifth is income from other sources. So second head, income from house property, you can claim deduction of interest amount. Now, there are different situations in both the cases. First, I'll talk about let out. You own a house and you have let it out. A tenant is living there and you are getting monthly rent. Whatever monthly rent you get is taxable under the head income from house property. But out of that, you get a deduction of interest on loan. So whatever interest on loan you are paying, you will get the deduction. Suppose you had borrowed 75 lakh rupees to buy the house. And on that 75 lakh rupees that you had borrowed, every year, interest part that you have to pay is 5 lakh rupees. ₹5 lakh is the interest part that you have to pay. Now, this house you have let out at the rent of 30,000 per month. The rental income is 3,60,000. Whereas you are paying interest on your EMI, 5 lakh rupees per annum. So out of this 3,60,000 rental income received, interest on loan will be allowed as a deduction, 5 lakh rupees. It will come in negative. The government says you cannot book a loss if your interest amount is more than the rental income, then your income will be treated as nil. You can take interest on loan deduction up to the extent of your income. So 3,60,000 rupees was my income, rental income, and I paid interest of 5 lakh rupees. But since my income is only 3,60,000, I can claim full 3,60,000 as a deduction, and I will not have to pay any tax on house property. I have claimed the interest component. The principal component I can claim under deduction under Section 80C, and the interest component I have claimed deduction under the head income from house property. 3,60,000 was my rental income. I can claim deduction up to 3,60,000. Suppose my rental income was 40,000 per month, 4,80,000. Since I am paying interest of 5 lakh rupees, full 4,80,000 I can claim as a deduction. So I will not have to pay tax on my rental income. Big benefit. You are earning rental income, not paying any tax. You got the deduction on interest on loan. So in fact, 40,000 rupee rent that you are getting, now this is a big source of revenue for you, which you can utilize in paying your EMI. EMI देने में आसानी हो गई. Rental income से EMI you are able to pay. Some part of EMI you can pay through your rental income. And rental income, you are not paying any tax. Why? Because interest on loan deduction you have taken, the income under the head house property has become nil. The second option is that you engage the house for your own self-occupied house. And you borrow money from the bank to acquire or construct a self-occupied house. You get the possession of the house and you occupy it yourself. Now, one house as self-occupied is exempted from tax. There is no tax. So this self-occupied house, no income tax. Self-occupied, you are living, no income tax. But the interest that you are paying, here it is allowed maximum up to 2 lakh rupees per annum. So if you have let out the house, then actual amount of interest can be claimed as deduction. But if you have not let out, you are living in your house yourself, then in that case, interest on loan deduction you can claim is only up to 2 lakh rupees. Actual amount or 2 lakh rupees, whichever is less, will be allowed as a deduction. So friends, if you have purchased or constructed the house, living yourself, borrowed money, then in that case, you can claim a deduction of 2 lakh rupees. And if you have let out the house, then you can claim actual interest paid as a deduction. And if you have, or if you have taken loan for repair renovation, then the deduction is up to 30,000 rupees, actual amount or 30,000. If you are taking the loan for repair renovation, then 30,000 rupees you can claim a deduction. So that was about house. So it is advisable, as I said, that whenever you buy or construct a house, always take a loan. When you take a loan, in fact, these days, without taking loan, it's not possible to buy or construct a house. So when you take a loan, you get the income tax benefit. Interest part, what you pay, you can claim as deduction. I hope it is clear. Any query as far as this part is concerned?
So far, no questions, sir.
There are no
Uh,
questions for two reasons. Sometimes people do not take interest and they do not understand anything. That is why there are no questions. Or secondly, sometimes when they understand everything, they have no questions. I don't know which is correct.
which one? So let
Because,
us assume, sir, because these all are faculty members, let us assume they understand.
yes. And online classes, uh, one person is writing it is that they are liking the lecture, they are enjoying it. So
Yes.
you see, I'm not taking anything from the book, just general tips I'm giving you. Like if you buy or construct
Yes.
a house, what thing you should keep about income tax, how you can maximize wealth through stock market, mutual funds. One thing I wanted to talk when you invest in mutual fund is through SIP, systematic investment plan. And thousands lakhs of people are investing in mutual fund through SIP. I hope you people must be knowing what is SIP, systematic investment plan, where you do not put your money, you do not invest your money at one go. Suppose I have to invest 1 lakh rupee, so I do not invest 1 lakh rupee at one time. I invest 1 lakh rupee at the rate of 10,000 every month. Systematic investment plan. As you go on earning, you go on investing. And when you invest in the mutual fund through SIP, you give a standing instruction to the bank that every month on such and such dates, so much of my amount should be transferred to this particular mutual fund. So you don't even have to remember. You automatically, your funds from your account will be transferred to the mutual fund. So gradually, when you invest in the mutual fund, 10,000 per month or 15,000 per month, then your returns are higher as compared to one-time investment. Why? Because one-time investment when you make, suppose the stock market is very high on that day, and later on the stock market goes down. So you invested when the stock market was at its highest, And thereafter, the stock market has gone down, so your returns will also go down. But under systematic investment plan, there is a averaging of investment. You invest in January, then February, then March, April, May. So your mutual fund has invested your money month-wise. So sometimes they invested when the stock market was low. Sometimes they have invested when the stock market was high. So the average returns in this case are definitely better than investing at one go. So many of the people, salaried class people, at the moment, I have seen investing through SIP, systematic investment plan. The other thing, I was talking about gifts. We love to give gifts to each other. Dear friends, under the Income Tax Act, now there are a lot of provisions relating to clubbing of income. Now every person should know about this. Clubbing of income, gifts. But before that, first let me complete about mutual funds and stock market. As I said, when the mutual fund earns money, it returns the money, some part of it, to its investors by way of dividends. Similarly, when you invest in the stock market, the companies distribute dividend. Previously, dividend income was exempted. But from the last 2 years, now dividend income has become fully taxable. So if you receive any dividend from shares, either from mutual funds or from shares, it is fully taxable under the head income from other sources. Remember that dividend income is always fully taxable. So it is not advisable that you opt for a dividend plan. You opt for a growth plan where you will not get the dividend. Whatever dividend you will receive every will be reinvested. Growth plan. So when you invest through growth plan, you will not get dividend. So every year dividend amount will not be taxable in your case. Rather, that money will be reinvested, and afterwards you can take a lump sum amount by encashing your units in the mutual fund, and that will be treated as long-term capital gain. Since after 12 months you will be encashing it, up to 1 lakh rupees that will be exempted, and more than that, only 10% tax you have to pay. So that was my little knowledge that I wanted to share with you about the mutual funds, about the stock market. Now I come back to the gifts part. Clubbing of provisions, gifts. Many of the SSCs do not know about it. Clubbing. What is clubbing? When the income of two people is added together and one among them pays the tax, then that is called clubbing of income. Like husband, wife, their income are clubbed. If husband is working separately, wife is serving separately, then income will not be clubbed. Wife will pay her own taxes, husband will pay his own taxes. No clubbing. If both are earning separately. But suppose if the wife is not earning, she is a housewife, and husband is only earning, then income tax people believe that whatever income arises to the wife belongs to her husband. It is because of her husband that she has an income. She is a housewife. She is not earning separately. So if a husband makes a gift to his wife, suppose I make a gift of 5 lakh rupees to my wife, and my wife invests that money through a bank fixed deposit and at the rate of 10%. So I made a gift of 5 lakh rupees to my wife. She has invested that money through fixed deposit with the bank at the rate of 10%. On 5 lakh rupees at the rate of 10%, she will earn 50,000 rupees during the year as interest. Though my wife has earned this 550,000 rupees interest income, but this income will be clubbed with my income. She will not pay the tax on that. This income will be added to my income, and I will have to pay the tax on this 50,000, not my wife. Why? Because the money belonged to me. She has invested my money, so income should also be taxable to me. Husband, wife, there are clubbing provisions. Similarly, if you have a minor child and a minor child has got any income, so that will be clubbed with the income of the parents. Parents will have to pay tax on that, not the minor. And the provisions are that up to 1,500 rupees per child shall be exempted. And beyond 1,500 rupees will be clubbed with the income of the parents, and parents will have to pay the tax on that. Suppose I have a child, 6 years old. He received lot of gifts from relatives, from friends on his birthday. First birthday, second birthday, third birthday, fourth birthday, fifth birthday. Every year is getting lot of gifts from his friends and relatives. And the father puts that money in the bank account, makes a fixed deposit. Interest income is earned by the child in his name. Suppose the interest income earned is 30,000 rupees during the year. So this will be clubbed with the income of the parents, and while doing so, 1,500 rupees will be exempted. The rest of the income will be clubbed, added to the income of the parents, and they will have to pay the tax on this. But there is one exception. If the child is earning some money because of his own diligence, own skill, own knowledge, then that income will not be clubbed. On that income, the child will pay its own tax. Paying own tax separately, you are benefited because you get separate exemption of 2,50,000. If you become a separate SSC, 2,50,000 exemption you can claim separately. Then 5% slab system will apply, 5%, 20%, 30%. And if the income is clubbed, suppose it is clubbed with the income of the parents, father, and father is already paying tax at the rate of 30%, he is in the highest bracket. So whatever the minor earns above 1,500, father will have to pay tax at the rate of 30%. Because when that income is added in the income of the father, and father is already paying tax at the highest rate, he will have to pay tax at the highest rate. So minor out of skill, diligence, knowledge, if minor is earning any income, that will not be clubbed. I remember Sachin Tendulkar was a minor when he joined Indian cricket team. And by the time he turned 18, he was already a celebrity. You people watch television, serials, movies, lot of child artists perform. Lot of. If you look at the advertisements, lot of child artists perform. And they earn huge amount of money by acting in films, by taking part in reality shows, although they are minor. Now, this income will not be clubbed with the income of their parents. Minor will pay his or her own separate tax. Minor will be treated as a separate SSC. His income will be calculated separately, and minor will pay his own tax. It will not be added to the income of the parents. So clubbing provisions, there are many others. Here I have told you ones which are more relevant: husband, wife, children and parents, their income are clubbed provided they are not earning separately. But if they are earning separately, then in that case, income will not be clubbed. They will become separate SSCs and they will pay their own taxes. Now, gifts I was talking about. Previously, there was a Gift Tax Act which has now been abolished. The provisions were that the person who gave the gift, had to pay gift tax also. Yani, if I make a gift to somebody 5 lakh rupees, so I'll give a gift of 5 lakh rupees, plus I'll have to pay the gift tax also on that 5 lakh rupees. The provisions were very absurd. For the last many years now, gift tax has been abolished. Now the provisions have been changed, and it is now the person who will receive the gift, recipient of the gift, he is liable to pay the tax on that. Gift will be added in the income of the person under the head income from other sources, and he will have to pay taxes on the gifts, provided gifts in cash or kind from a non-relative exceed 50,000 rupees. Now, this point I want to clarify. When you get gift can be from a relative or it can be from a non-relative. Non-relative, friends, etc. The provisions are that if the gift has been received from non-relatives, then in aggregate should not be more than 50,000 rupees in a year. If it is up to 50,000 rupees in aggregate from all the people, non-relatives who have made gift up to 50,000, it is exempted. No tax is to be paid. And friends, kindly note it. If it exceeds 50,000, then tax will be paid on the full amount. I take one example. Suppose my friend gives me a gift of 60,000 rupees. So it exceeds 50,000. Now I will have to pay tax on full 60,000. It's not like that up to 50,000 it is exempted, that I have to pay tax only on remaining 10,000. It is not like that. If your gift exceeds 50,000 in a year, you will have to pay tax on the full amount as per your tax slab. So friends, be cautious about it, that if you are receiving gift from your non-relatives, it should be up to 50,000 rupees only. If it is even 50,100, you will have to pay tax on full 50,100. And if it is 50,000, no tax will be paid. So be cautious when you receive gifts from your friends. In aggregate, from all your friends during the year up to 50,000. Second is, when you receive gift from your relatives, then it is fully exempted. No tax is to be paid. Now, relatives have been defined: mother side, father side, all relatives from mother side, father side, husband side, wife side, all relatives, any relative, mother-in-law, father-in-law, sister-in-law, brother-in-law, grandfather, grandmother, brother, sister, any relative makes you any amount of gift, whether in cash or kind, it is fully exempted. Suppose my brother gives me a gift of new car costing 10 lakh rupees. My brother, it is in kind. It will be converted into monetary terms. 10 lakh rupees. Suppose that is the value. Since it is given by my brother, it shall be fully exempted for me. I will not have to pay any tax. But suppose my friend has gifted me a car of 10 lakh rupees, then I will have to pay tax on full 10 lakh rupees. That will be treated as my income. And if I am in the highest tax slab, I will have to pay tax at the rate of 30%. To relatives, any amount of gift you receive, no tax at all. And another thing, if any of you amongst you who are joining here today are unmarried, any gifts received at the time of marriage, whether from relative or non-relative, to any extent, that is fully exempted from tax. So all non-relatives who give you gift at the time of your marriage, this limit of 50,000 will not apply. In that case, it will be fully exempted. So before marriage, after marriage, when you receive the gifts, then from non-relatives, it is exempted up to 50,000. But at the time of marriage, when you have your wedding reception and you receive the gift from non-relatives, then this rule of 50,000 will not apply. It shall be fully exempted. I hope it is clear. Any queries as far as this part is concerned? You are clear about the gifts. You are clear about clubbing provisions. You are clear about tax provisions relating to investment in stock market, mutual funds. You are clear about taking health insurance policy. You are clear about Section 80 TTA deduction, the interest that you earn from your bank. You clear about the investment that you make in your Section 80C. No questions up till now?
No question, sir.
Okay. So, Professor Singh, these were some of the tips, main tips. I did not teach them income tax, rather I gave them some important tips related to various aspects which may help their in day to day, whether in the form of gifts, clubbing of provisions, house property, capital gain. So these were some of the important tips. Another thing is that since I told them there is a provision for TDA, tax deducted at source. I hope they must have understood what is the meaning of this tax deducted at source. Whatever income that you earn, your employer deducts tax on that. And the end of the year, when you pay your taxes, you get a credit of that. Whatever taxes have been deducted, finally, when you pay your taxes, you get the credit of that, and then the remaining tax you are required to pay. So, in fact, your TDS is not harmful as you would have paid all the tax at one time at the end of the year. This is how gradually every month you are paying some part of it as taxes. So TDS is not a bad thing, although psychologically you feel as if you have gotten less salary, your tax has been deducted. So that is just a psychological feeling that your tax has been deducted. If it is not deducted, then at the end of the year you have to pay the taxes. You can't evade the taxes. You have to pay taxes. So TDS is something not bad. It looks psychologically that your some part of the salary has gone to taxes. Government is your partner. Don't think that you are a sole proprietor. You are always a partner, and government is one of your biggest partners. Whatever you earn, the government will always come with its own share of profit by way of income tax. You have to pay a certain part of your income to your partner government. Whether you like it or you may not like it, you will have to pay the taxes. You can't. So no more questions coming. So should we wind up then?
Sir, no question. This was this is a topic where everyone is struggling with. But no question is coming, sir. I am having one question. Sir, in section NPS deduction from employees, new employees, there is a deduction up to 1.5 lakh under section 80 CCD1. And then under section 80 CCD1B, 50,000 additional over and above.
This is what I told you in the beginning.
Yeah.
CCD 50,000
Yes,
additional.
1B. Yes, 1B, sir.
So maximum
Now,
you
just
can take is 2 lakh rupees. 1,50,000 you can take it section 80C, and there's the additional deduction under section 80 CCD 50,000. So if you contribute any extra amount in new pension scheme, then you claim extra deduction of 50,000. So 1,50,000 section 80C and 50,000 especially under section 80 CCD.
1B, yes.
So total you can claim it 2 lakh rupees as
2 lakh
deduction.
rupees. So it can be bifurcated. It is legally allowed. Like just
Yes,
suppose
it is
I'm not
legally
having.
allowed.
Yeah.
It is legally allowed.
Legally.
There are a lot
Because
of
just
people who are availing it.
yes. Okay.
You see, it depends. It depends how much you want to save for your retirement.
Mhm.
If you are there are two things: whether you want to live in present or you want to save for future. If you want to live for present, you don't save money, you spend the money. You enjoy your life. And if you're more concerned about your retirement, then you set aside money up to 50,000. Government is giving you incentive in the form of deduction.
Sir, actually, my question is not on additional deduction. Just suppose I'm not having any saving, and my total NPS deduction is say 2,10,000, more than 2 lakh. NPS
Then you will
deduction
get deduction maximum only up to 50,000 rupees under CCT and 1,50,000 under ATC.
So same amount can be bifurcated. Both.
Yes, that can be
Okay.
bifurcated.
Okay. That is actually in the act. It is not very clearly mentioned. It is written over and above. Sometimes it feels like over and above means additional contribution.
You see, I told in the beginning, ATC 1,50,000. There are 25 items where you can put your money. You can invest your money. Maximum limit is 1,50,000 that you can claim as deduction. So if you are not putting your money in any other scheme, you are putting your money only in NPS, then 1,50,000 you can take deduction under section 80C. And if you want to contribute more, then government has given you one more option under section 80 CCD. You can put in extra 50,000 rupees in your NPS account and you can claim further deduction. So 1,50,000 max in section 80C, 50,000 additional CCD, max you can take is 2 lakh rupees of deduction, not more than that.
Okay, sir. So there is no other question in the chat box or Q&A. So in that case, we can round up, sir. Thanks for sparing your time and giving very good tips on income tax. Although you have not received any question, but we have received a lot of tips from you for management of our taxes. And March is arriving very soon. And then July will be there for tax filing. So these things we are being utilized, sir. And when we will file our tax, we will remember you and say thanks again at that time. So,
okay, thank you so much.
But before that, on behalf of all the participants, on behalf of HRDC, and on behalf of the coordinators, I would like to say thanks to you for sparing your time. Thank you, sir.
Thank you so much. Thank you.
So, dear participants, this is all about today's 4 sessions. Now, tomorrow morning, again, we will reassemble at 10 a.m. And again, we'll be having 4 new topics with 4 new resource persons. So, first session will start at 10 a.m. with Professor O.P. Rai, who was former Pro-Vice Chancellor of University of South Bihar, and he is head and dean of Faculty of Commerce, Banaras Hindu University. He will be talking about the scientific stress management, the master key for success. Then second topic will be on emotional intelligence, and that will be delivered by Professor H. Malswamy. She is in Department of Education, Mizoram University. Third session will be taken by Professor R.K. Noting Huma. He is presently he is Dean School of SEMIS, and he belongs to Department of Library Science of Mizoram University. And he will be talking on role of library in society. And the fourth and last session for tomorrow will be on the topic principles of curriculum